everyone, and welcome to today's Asia Society event, Disruptive Asia, the Rise of Impact Investing and Sustainable Finance in Asia. My name is Thomas Owen. I'm the Executive Director of Asia Society Australia and the curator of the 2020 Disruptive Asia Sustainability Edition. Before we begin, we acknowledge that many participants in today's event are dialing in from locations that have traditional owners and custodians. I'm currently on the traditional land of the Woolamita people just north of Sydney. I would like to acknowledge all traditional owners and pay my respects to elders, past, present, and emerging. I'd also like to welcome and acknowledge any Aboriginal, Torres Strait Islander, or First Nation people joining our webcast today. I'm absolutely delighted to welcome you all to today's event, bringing Asia Society's Disruptive Asia publication to life once again with a really important discussion. This morning, our panel will explore the role of impact investing and sustainable finance in building a more resilient, inclusive, and sustainable economic environment across the region. This conversation is timely. In tandem with a growing global health crisis, our economic crisis deepens, and those who feel it most are people and their communities. At a time where the need to restart economic growth is urgent, how do we balance purpose with profits? And how do we deliver economic outcomes that are inclusive and sustainable and that can safeguard and build future resilience? Before I introduce our expert panel tasked with answering these questions, let me briefly turn to some housekeeping. Today's event will run for about 50 minutes, with 30 minutes for our panel discussion and 15 minutes for audience questions and answers. Please submit a question at any time in the YouTube live chat box located to the right of your feed, and we'll try to get to as many as possible. It's now my great pleasure to introduce our panel today, a truly inspirational and international group of people. For further background on our speakers, be sure to follow the link we are sharing with you in our chat box now. From Singapore, we are joined by Durreen Shahnaz, a pioneer on impact investing and the founder and CEO of Impact Investment Exchange and the IIX Foundation. Durreen is also an Asia 21 alumni, a global emerging leaders program, and a former Asia game changer, which honors leaders who are making a significant contribution to the future of Asia. Dialing in from Boston, we have another Asia 21 alumni, Emily Chu, Global Head of Sustainability at Morgan Stanley Investment Management. Emily also chairs the firm's Sustainable Investing Council. From Beijing, we are joined by Stefen Shin, the Principal Investment Officer in the Capital Markets and Structured Products Investment Operations Department at the Asian Infrastructure Investment Bank. And last but not least, from my adopted home in Sydney, we are joined by Catia Davim, partner at KPMG, leading people and transformational change practice. Catia is also the founder of the Social Good Summit Australia, a UN-led initiative that examines the impact of social good initiatives around the world. So an outstanding panel and a very warm welcome to all of you, and thank you very much for joining us today. Durreen, I'd like to start with you. Impact investing, a term that really came to the fore following the GFC in 2008, is still a young concept in Asia. You have had and continue to have a significant role in the development of impact investment in the region. I wanted to start this conversation with your insights on the current state of impact investing in Asia and how far has it come in the last decade or so. Durreen.
Thank you, Thomas, and a very good morning to everyone. It's wonderful to be part of this esteemed panel. A very good morning to all of my panelists. It's a very good question to start with, so thank you for starting on that note. You know, it's very interesting. I think the impact investing, you know, while it sounds like it's a young concept in Asia, it has been around in many different forms over the decades. So in terms of my own journey, I founded IX over a decade ago to really with one goal, which was to give women a voice in the financial markets. I started my own financial career over 30 years ago at Morgan Stanley in New York. And I was literally the first Bangladeshi woman to be working there. And it was quite remarkable how few women and women of color were there. And what was very interesting for me is when I actually made the journey from Morgan Stanley back to Bangladesh to work at Grameen Bank, for me, the most profound learning was the fact that if we are going to make any systematic change, we need to be able to connect the Wall Street to the back street of the underserved communities. And that has been the journey. And it was wonderful when Rockefeller Foundation had me as a part of the group in Italy, where the term impact investing was coined and the whole movement started. Now, it's very interesting in terms of, I guess, the impact investing movement and what IX has done over the last decade, 11 years. We have been able to unlock over $200 million and impacting over 80 million lives across Asia Pacific. And then in terms of impact investing in Asia, the numbers, it's about $12 billion in various forms. Now, the big reason for that, of course, is that in Asia, we do have a growing population of ultra wealthy, and also it's the home of the world's most challenging social and environmental problems. So we have now a bit of the two extremes. And what impact investing has allowed us to do is really be able to pull the two together most effectively. And I think, as many of you know, many of the listeners know who are from Asia, philanthropy is not something that's practiced in a very open way in Asia. So impact investing and sustainable investing is quickly becoming that agent of change for many, with the wealth and with the investment capability in Asia. So I do think it has been going on, but now it's been happening more formally, and it's wonderful that IX can play a role in it.
Thanks very much, Durreen. And we'll come back to some of the trends and the role impact investing is now having, and your view on where it's might take us in the next decade as we go towards the 2030 agenda. I wanted to come to Stefen now. As huge amounts of money are being directed to the pandemic recovery efforts, the UN and many world leaders have called for a COVID recovery that is aligned with a Paris Agreement and the SDG commitments. How do you think sustainability will fare in the region as many countries are still very much tackling the current pandemic? Are we likely to see a reduction or stagnation in sustainable finance, or can it help build momentum and accelerate our efforts? Stefen.
Thank you for that, Thomas. I think the region as a whole, economy will stagnate a bit, as you are all aware. But I think as we're coming out of it, I think there will be a lot more focus on sustainability and sustainable investment as a whole. I think we've seen lots of data points that work toward that. I think the reason is that everyone understands actually that sustainability and responsible investment is really the way of the future. But I think people were just really kind of busy with whatever they were doing to really get it really going. And I think what COVID pandemic has done, it has hit the global kind of economy on pause for a bit. And as we get restarted, I think the priority shifting has gotten much better. So as we're coming out of it, I see a lot more institutional investors, as well as organizations who place a priority on sustainable investments. And I think you're going to see a lot more, especially for climate. For the region, it's very important because Asia is right in the center of both being one of the most kind of the polluters, as well as having the funds, like Durreen was saying, that can combat and to really help spur climate action and climate finance. So I think in Asia, a large portion of the responsibility as well as the problem exists. So I think it's very important that that the sustainable investment kind of space really takes off, and I think it will, and I think we're seeing early signs of that.
That's good to hear. And I want to stay a little bit on this topic, but come to you, Emily. In an earlier conversation we had with Patrick Suckling, former Australian ambassador for the environment and now senior fellow with Asia Society Policy Institute, he said, governments as well as corporates must place sustainability at the center of our recovery efforts and also future investment strategies. I think many of us would agree, that line of argument is right, but is this actually happening? And how do we balance the immediate recovery efforts with investing in long-term sustainable products? Can we do both? Emily.
Thanks, Thomas, and it's great to be with you here today, tonight my time, morning your time. So I just want to reiterate what Stefen said, which is that sustainable and responsible investing is at this stage a mainstream movement in the finance sector. When we think about sustainable finance, we're talking about the banking, the investment, and the insurance. I come from the investment background, but really it's broader than just investment. And government policy is absolutely critical for scaling up this practice, if you like, or this orientation in the finance sector and the way capital is deployed. And we have seen some notable commitments made among governments as part of their COVID relief stimulus packages, most notably the EU with 30% of their stimulus package targeting green outcomes or green investments. South Korea notably as well, around 37%. Targeting renewable energy, energy storage, electrical vehicle charging infrastructure, microgrids, etc., like a whole raft of initiatives. Also Germany, France, we've seen Canada, and Canada and France tie some of their stimulus package to green or climate related outcomes for certain companies, or tie incentives, incentivize companies essentially. However, overall, we are really seeing, I think, not the bulk of stimulus money or policy really being geared towards climate change mitigation, adaptation, or mitigating the environmental crisis that we are obviously in already. One analyst estimated it was only about 3% of total stimulus announced globally in the last few months has been targeted to climate initiatives. And I think to your question about, how do we balance the trade-off, between the short term and the long term, obviously there's a need for a short-term reaction. I just mentioned South Korea. South Korea has a fantastic Green New Deal policy framework, but they've also been criticized for bailing out a coal-related company and a nuclear-related company because things are in crisis. But I think if we were to essentially, from an economic level, look at some of these factors and properly value them, we wouldn't see it as a trade-off. Climate change is already causing trillions of dollars of damage to the global economy annually. We also have hidden costs, health costs around the burning of fossil fuels. And so if we were truly building the externalities into our economic modeling, I don't think that the long-term and short-term would be dichotomized as a trade-off. So that's essentially what we do in the sustainable investment field, is to try to look at things that have historically been positioned as externalities or not relevant to the financial decision. And it's really a process of broadening the viewfinder, if you like, and looking at a number of environmental and social factors and putting them into valuations today. The risk of an occurrence or the opportunity captured because of the way these issues are being managed at the company level.
Well, I think that's true. And I think this is a good point to bring Catia into the conversation as well. Obviously, a key objective of the Social Good Summits has been to examine the impact of social good initiatives around the world. And as many sectors and industries now are obviously doing it very tough and will do for some time, how is the pandemic impacting, in your view, support and financing of some of these initiatives that your platform has really been focusing on and been trying to, I guess, profile and give awareness to?
Thanks, Thomas. Good to be with everybody, and I'm dialing from the Gadigal people in Sydney, in the place called Barangaroo, which is an Aboriginal word in itself. So, Thomas, I think that surely, many of the effort now is to resolve the pandemic, which is the most immediate crisis here. But we cannot forget that we are, in the middle of a health crisis, economical crisis, and environmental crisis that are kind of combined all together. I think that one good aspect about the pandemic is that you start seeing, if you think about the kind of the vaccine effort, the search for a vaccine for the pandemic is bringing a degree of collaboration in the pharmaceutical industry, to solve kind of a problem that is affecting all of us. AstraZeneca collaborating with the Oxford University. So I think that we are seeing models of collaboration to solve critical problems because there is a kind of an immediate crisis. Now, what I'm hopeful for is that we could actually apply the same model to solve, cancer, dengue, malaria, disease that affects, poor and rich regions around the world. Obviously, as well, the degree of collaboration to solve critical problems like climate change, to Emily's issue, is not a problem of the future, it's a problem of the present, and is creating a lot of pain already. So I think that, if you start exploring those models, surely, a lot of investment is being done to resolve the immediate crisis. But I think that the kind of the climate change crisis is not going away. We are very conscious of that, and we actually know that is going to create even more bigger problems if you don't resolve that in a collaborative way. So my hope is that we find models of looking at problems in a very different way for the benefit of everybody.
Well, I think that's true, and I think someone has coined there's nothing like a good crisis, but with all respect to the heartache that this is impacting us, I think we need to look at it as an opportunity to be innovative and to change and try to be even more focused on the real problems. I want to come back to Durreen now, and I guess building on some of my introductory remarks, a key question we have discussed in our Disruptive Asia series this year has focused on community resilience, community-led approaches, and how we ensure inclusive and sustainable growth. The argument really that has been made is that development is not sustainable if it's not fair and inclusive. And with increasing social and environmental issues adversely affecting many communities across the region, as you spoke to as well, how is social impact investing making a difference? What are some of the realities you are dealing with every day in the region where social impact investing is really working to foster community resilience?
Right. So it's interesting, Thomas, despite sort of the growth of sustainable investing in Asia Pacific, as I mentioned, there was incredible inequality in the system. But now COVID has, of course, exacerbated, that inequality and really forced us to ask how green and how social are sustainable investings that are actually happening. Now, if you look at it, Moody's forecasted that sustainable bond issuance in 2020 is going to hit between 325 billion to 375 billion. So, enormous number. Now, how much of that is really going to the last mile? The answer is zero. Now, again, if you look at just even the social bonds of 9.5 billion that was issued by entities, a lot of these large banks who are usually active in the green bond, none had a gender lens or any explicit mandate to support women, and they're called social bonds. So I think what's happening is, there is, of course, a dialogue that's going on. There is an acknowledgement. However, I think people are still very, very much myopic about the fact that they're going to maximize the profit and really not be looking at it in a holistic way. Now, at this critical time, the need of the hour is not only to respond to the pandemic, but also to create long-term COVID resilience. by building back better and stronger systems. So we are not going to get out of this crisis if you really don't have an approach where every stakeholder is benefiting from. So at IAX, we have put a lot of emphasis on innovative products, and one of them, which has sort of taken the world by storm, is the Women's Livelihood Bond Series. It's a 150 million bond series, which is impacting 3 million women literally on the ground, and using finance in an effective way to really have them make that journey to the capital markets of the world. Now, we need to, and it wasn't easy to create a structure like that, but it is a necessity. And I think that's the imperative, we want to make sure everyone embraces as well. In terms of community resilience, it is fosters when you directly impact women to transition to sustainable livelihoods, and also indirectly impact young girls and households. Because again, let's not forget, again, I'm talking about Asia Pacific here, we still have over 800 million people who live under $2 a day, right? And it's just not in developing countries. We have many of them now in Australia as well, right? And in the Pacific and all that. So it is something we need to grapple with, and COVID-19 continues to exacerbate that. And we need to actually say, how are we going to create livelihood, for these people, for these women, using innovative finance? And as we're touting these big bonds that everyone is doing, we need to actually say if it's actually moving the needle. Sadly, I don't think we are holding the mirror to ourselves and asking that. So that is sort of the big challenge, and we have to make sure that we don't get caught up in the excitement that everyone's talking about the sustainability, using words like sustainability, using words like green bond, social bond, but really look under the hood to make sure we have every single stakeholder as a part of the system.
Very good points, and we'll unpack some of that a bit later on. But I think immediately that comes to mind as well is obviously the concept of shared value or creating shared value. And Catia, I'll come to you again. Obviously, this is something you've been working on as well, and I think is very relevant to this discussion, but also have, I guess, different views based on where you sit, the whole concept of growing profits for business while delivering value to the community. How does this really work in practice? And again, how does it help build resilience for a community? Catia.
Thanks, Thomas. So the concept of creating shared value is absolutely relevant in this context. When you talk about impact investing, when you're talking about getting out of a crisis and so on. The concept is a business model. So the whole intent is to provide competitive advantage to an organization. But the way we do that, and if you go back, traditionally, the role of an organization is to bring, create shareholder value. Well, things are changing quite a lot in this domain. So, if you look at Business Roundtable in the US, a large organization that represents the top 180 CEOs of the biggest organizations in US, signed this agreement that actually the mission of an organization is not just to look into the shareholder value, but actually the stakeholder value. So what we are assisting, if you want, is a completely mindset shift on the domain of business. Certainly, we are not just looking into the profit per se, but we are actually looking at the whole ecosystem. And to Durreen's point, we are not going to go anywhere if we don't take care of all stakeholders. And that's kind of was a statement that was is a document, but tremendously shifts the whole agenda around the way of doing business. Shareholder value is very aligned with that. So basically it happens when an organization is able to identify a business model, a business opportunity in the market that brings either an increase of revenue or reduce the costs, and at the same time is providing some sort of social impact or social benefit for the society or for the environment. There are many examples of that. Bringing one close to our heart in Australia, NAB, which is one of our largest banks, launched a few years the NAB Assists program, which is basically when their clients enter into mortgage default or some sort of default, they actually, instead of treat them as the bad guys, they actually have teams specialized, and this is done in collaboration with some not-for-profit organizations to actually try to identify a solution for the household. So instead of push these people to poverty, and to Durreen's point again, we have a lot of poverty in Australia, shockingly, in a kind of a considered a rich country. So this team basically have a dialogue and a discussion and find a way to find a financial solution for the family and progress and keep them as a client. What they identify with this process is that the organization save a lot of money through this process. So the whole supply chain, and basically the costs associated with mortgage defaults actually improve quite a lot. So this is kind of a very practical example of that. We have larger scale organizations. Enel is another example of a company in Italy that completely shifts their business model that happened, more than 10 years ago, to a completely green energy type of business model. So what we are assisting is, so the concept of creating shared value is this idea of let's totally rethink our business model. Is not an organization or a business just providing some money for charity or applying kind of the sustainability agenda on the edges. Is truly looking into their business strategy, their positioning in the market, and how can we reinvent ourselves to recreate an ecosystem that benefits society and the organization at the same time.
Thank you, Catia. I think another point I want to kind of draw on now, and coming to you, Emily, we talk about the key stakeholders in the ecosystem, so to speak, of impact investing and sustainable finance. Obviously, government themselves play an important role in putting regulation and measures and policy settings in place, I guess, to facilitate that stronger environment and opportunity for sustainable finance. You mentioned some of the countries in Europe and also the case of Korea in your earlier remarks. But maybe we can kind of try to go a bit deeper. What are some of the governments really doing to try to enable more sustainable investments in Asia? And are the policy settings right? What more do we need to see from governments to enable a better environment for sustainable investing?
Thanks, Thomas. There'd be a long list if we were to really go through that. And I'll also speak really focused in on the investment case. As I mentioned earlier, the concept of sustainable finance is broad. There's banking, there's insurance, there's small business. There's a lot happening across the board. But if I just think about the case of investment, so large pools of capital collected in pension funds or in sovereign wealth funds that are being invested in the capital markets across asset classes. I'd say broadly there's three buckets or types of regulation which is facilitating this, and we see several examples of this across the Asian region. The first kind of category would be enhanced company reporting. So the building blocks of sustainable investing is having the transparency into the issuers of either equities or bonds, but also if you're investing in a private company, but having the transparency around the actual data metrics, the actual performance on environmental, social, and governance characteristics in order to be able to weigh up the attractiveness of that investment in light of those metrics, combined with all of your traditional financial analysis. So actually in Asia, we see several examples of mandated ESG reporting for large listed companies. It's mandatory in parts of the Chinese market. They were bringing it online with a 2020, phasing it in with a 2020 deadline that may be pushed back a little bit because of COVID, but ultimately the signal is very clear for mainland China. Taiwan, Malaysia also have mandatory ESG reporting for their large listed companies. In Hong Kong, you have a comply or explain regime where the metrics are prescribed. You have to report them as a listed company in Hong Kong or explain why you don't think you need to. And increasingly, the standard of reporting is improving and getting more stringent over time in a number of these jurisdictions. The second category, I would say, is regulation or soft law that tries to influence investor behavior. So what we see in Asia, for example, is the proliferation of what's known as stewardship codes. These are generally national voluntary documents or agreements. Sometimes they're formulated by the Financial Services Authority or capital markets regulator of a given country. And what these codes are essentially aiming to do is to have large investors commit to being active and commit to being diligent in the way that they manage client assets or assets on behalf of beneficiaries. So if we take the case of Japan, for example, they've got the oldest stewardship code in the region. The byline of the code is actually that it aims to promote sustainable growth of companies through investment and dialogue. It most recently has incorporated explicit references to sustainability, which it defines as medium and long-term sustainability factors, including ESG factors. The stewardship code actually puts this language into the code and makes it part of the scope of responsibilities of an investor to incorporate it into the investment process and to have conversations with companies about how companies are performing against those ESG factors. I think the third kind of category of regulation, and that's newer in Asia, is regulation that classifies either the type of instrument or the type of fund as sustainable. So in the case of China, we have a green bond regulation that actually defines a certain list of acceptable activities that can be financed under the label of a green bond. In the case of Hong Kong, just this year, we've had the Quality Assurance Agency launch its Green Finance Certification Scheme for ESG funds that's trying to define what is an ESG fund and how do you get it certified and have an independent verification. So I would say that's the kind of least developed area of regulation, and more could be done there, particularly to make sure it's harmonized with what's happening in the EU, where there's a lot of very deep development in all of these areas. And I think in terms of what more could be done, I think just even more harmonization, even more coordination would be very, very welcome, particularly as a global investor, having to navigate the different soft and hard law regulations in different jurisdictions in this space is becoming increasingly complex. So I think even more coordination, harmonization across the region would be very welcome.
Thanks, Emily. And I want to go to another, obviously, key stakeholder, and coming to Stefen, and looking more at the corporate sector, broadly speaking, but particularly the financial services sector. They're really stepping up to be much more involved, much more proactive in creating sustainable, resilient future. The G20, for example, they've established the Sustainable Finance Study Group, and a global collaboration of more than 45 central banks is now working under the Central Banks and Supervisor Network for Greening the Financial System. We see an example here in Australia, for instance, the Australian Sustainable Finance Initiative. So how significant is this trend, and how important will it be for them to kind of continue on this trajectory of I guess, stepping up, being involved in terms of meeting the broader commitments under the Paris Agreement, but also, I guess, to Emily's point, I guess, coordinate and collaborate with other stakeholders, such as, key government agencies?
Thank you, Thomas. I think it's about time, right? It's about time that the financial sector has kind of picked it up and is starting to organize themselves that is aligned with sustainable investments, like the other panelists have mentioned. It's been around for a while, right? PRI kind of launched it 10 years ago. This theme has been around for a while. It hasn't really picked up. Several years ago, it started to really get this theme. A lot more has happened. So it's about time. And I think it's a response to the fact that, especially as you mentioned, Paris Agreement and basically climate finance, we're running out of time. And I think as the science of climate finance becomes more accurate, and as we realize that it is more science than art, I think financial institutions have recognized it. One of the key drivers for financial sector to really pick up, especially on the Paris Agreement and the contributions that each and every one of us, as well as the governments, have signed up to do, is that it's good for business. So when you talk about the field of finance, profit drives these financial sectors, and you have fiduciary obligations of performance. So when you look at overall ESG, you're doing good, but the whole concept of ESG has evolved where you actually should perform better if you are putting in these ESG factors, because you just are more attuned, and there's a lot more headline risk related to ESG kind of characters out there. In terms of climate, I think as the planet kind of warms up more and there's more erratic weather patterns, not only for climate mitigation, but for adaptation, where we need to be more resilient as a whole. I think that's becoming an investment theme, where if you have a factory, or if you're an investor, and if you're investing in a company that is highly impacted or will be highly impacted by the changes in our planet due to global warming, you should really identify that rather quickly, and probably before other investors do it, price it in your model, and do something about it, right? So if you kind of think about it, having those and analytical tools and being able to understand the impact of climate on your portfolio is going to make you, is going to help your bottom line. And I think that's what the financial sector has really understood. And in response to that, I think, as Emily was mentioning, and all initiatives going on with the government and kind of private sector organizations and formulating these regulations and guidelines, it's kind of all coming together. I think it's a significant trend. I think it's one that's going to continue. Like I said, especially with COVID, it would accelerate it, not decelerate it, just because the world has had time to hit reset. And it's like when your phone is broken, you're getting a new phone. What do? You make it better, right? You set it up correctly, right? So I think that's kind of the phase that the world is in, where we're trying to make it better, and we're hitting pause. We're coming out of it, and we're trying to install all these apps that are better, basically. And you can say these kind of apps are analytically similar to kind of these regulations that are coming out. So it is a significant trend, and I think we are in the business of trying to help our countries, as well as these companies, meet the commitment under the Paris Agreement, as well as do the things that the Paris Agreement is asking us to do.
Thanks very much, Stefen. And just to remind our audience to please pose your questions in the chat box. We're going to go around the panel, and I want to look a bit towards future trends, from your perspective and where you all sit. And I'll start with you, Emily, and then I'll come back to Durreen to give her views and kind of some concluding remarks there on impact investing. But Emily, a point you mentioned earlier, and as we look ahead, the global green bond issuance has increased dramatically in recent years, as we've spoken about offline, and obviously including in Asia. And growth is obviously set to continue as investors demand, green financing for key projects, including in infrastructure and also renewable energy. What is the outlook now for the green bond market in Asia? And I guess, can the region play more of a leadership role after it probably came a bit slow to enter this market in the first place?
Well, it's an incredibly fertile and interesting part of the bond market. I guess it's more broadly being referred to now as the sustainable bond market, which includes these subcategories of green, social, and broadly sustainable. I think Durreen made a fantastic point earlier about the labels sometimes washing over the details, and the need for the way we think about this space, obviously, to become a lot more integrated. But for better or worse, it's a growing category. There are bodies out there that are like the International Capital Markets Association, the Climate Bond Initiative, that are very carefully trying to lay out standards. And now we're seeing some of those standards around what counts as a green bond issuance being codified in the EU and in China. So Actually, I think, Thomas, the role of Asia in this space is not as far behind as some people may think. If you just look at China alone, they've been a major issuer of green bonds. If you look at state-owned banks, state-owned companies, the government itself, there's been a major issuance from China for several years now. In 2019, they were second only to the US in terms of single country issuance of green bonds. As of the end of the first half of 2020, cumulative issuance in Europe was 363 billion, but in APAC it was 194 billion. So actually not, miles and miles behind, although certainly some lag. The bulk of this is China. About 112 billion of that 194 billion has been China. And I think the most exciting development really in terms of the standards this year for China has been that they have now removed the category of financing clean coal out of their green bond standard. So that was a very big moment back in May, helped the international investment community get more confidence in the quality of the green bond market domestically. There's some hope that that may, as the domestic bond market opens up and becomes more accessible to international investors generally, that may also help instill confidence in that sector of the market. We've also seen in the last 18 months, Korea has actually surpassed has also been a major issuer of green bonds as well, green social sustainable bonds. One of the things that we need to be cautious about, however, is that in the post-pandemic environment, we've suddenly got a massive issuance of what's called social bonds or COVID-linked bonds. And I think it's fantastic that we have language and we have instruments that can help us directly address some of the social harm and some of the suffering and some of the needs for infrastructure development, vaccine funding, etc., through these instruments. But with the rush of funding, we've seen a little bit of a drop in the standards as well in the social COVID space. It's not as codified, it's not as well established as the green bond space. So that's just one area where investors will need to be very vigilant. Investors who are buying the bonds will need to be very vigilant in really holding companies to account in terms of how those proceeds are used.
Thanks, Emily. And I want to come to you now, Stefen, again, and just some remarks from you as well. As we look ahead, the Asian Infrastructure Investment Bank aims to launch a climate change investment framework that, in essence, is there to guide investors on climate change related financial risks and opportunities. Can you tell us a little bit more about this framework and what it might mean for the future of sustainable finance from the bank's perspective?
Sure. I like to kind of hop on what Emily and I think Durreen was saying about washing and greenwashing. So one of the issues with getting green bond, we love green bonds. We support it. We think it's great. We think it's great for market. It's great for transparency. Yes, there are some fine tuning that needs to be done, but overall, it's an improvement. And it's a temporary measure until people issuers can have more transparency and disclosure around kind of activities. The key word is activities, right? So if you look at kind of just only the green bond principles, it's a use of proceeds approach, which means if a corporation has 1 billion balance sheet and they issue 200 million of green bonds, they're responsible for disclosure over that 200 million. So for 200 million, they can trace the proceeds back to a green activity, and you codify, and then you have all these categories, and you can say, well, it's green. The problem with washing, and one of the problems that, one washing problem is that issuers, if they issue 200 million, they'll say, I'm a green bond issuer. But that's not really talking about the corporate, the whole 1 billion balance sheet, right? So people get confused because it's apple to orange comparison, right? Because you're looking at a product that identifies only $200 million of use of proceeds and doesn't really talk about 800 million of the overall balance sheet, right? So we thought that's not really the best way to do it. I think the green bonds is part of the solution. It's not really the best way to do it. So we think that the better way to do it is to look at it from a top-down corporate level issuance. So you're not looking at one particular issuance, but you're looking at the overall corporation or the entity, and you're going to try to use the Paris Agreement characteristics of mitigation adaptation, resilience, and transition to green, to see how much of the recommendation of the Paris Agreement that particular company is doing for the overall business. And I think that's the only way that you could really move the needle, because from an institutional investor point of view, you care about the issuance, but you're really more cared about the overall company, right? So, and the reason why we're tackling kind of the investor space is that we feel that right now, there's not enough incentive for the corporates to kind of implement the recommendation of the Paris Agreement, because green bonds is fine, but it doesn't give you overall kind of better pricing than your normal bonds. And people debate about it all the time. And I think you're asking just the wrong question. What you should be asking are, will corporates that align themselves with the Paris Agreement and do well under the Paris Agreement outperform those who are not doing it? We think that obviously they will over time. We don't know when, but they should outperform. So what we have launched is, together with Amundi as an asset manager and endorsed by CBI, is we have launched a framework that actually implements the Paris Agreement principles into a investor framework that identifies the correct climate risk under those three principles and tries to quantify that so institutional investors could actually use it in their daily investing practice, right? So this is kind of what we came up with. And the reason is that we wanted to do it ourselves for our money. And we realized that, when we talk to institutional investors, that a lot of institutional investors are looking at trying to do the same thing. So we thought, instead of everyone creating their own wheel, that we just kind of share our experience, and that can really enable other institutional investors to kind of quickly get to a point where they can really start looking at the overall company rather than just one particular issuance. And hopefully that can really kind of speed up the climate kind of finance field, so that people aren't looking at only the issuance, but really looking at the overall kind of corporate. And then institutional investors, if they start analyzing correctly, will be able to provide premium pricing or like lower debt financing or higher equity pricing for those companies that are really aligned with the Paris Agreement. And if that happens, then the corporates would then have incentive to do more action that is aligned with the Paris Agreement. So this is kind of like the overall, the future of the state that we think it will eventually go toward. We're not there yet, so we've launched a framework to really help catalyze that market.
Thanks, Stefen. That's very interesting, and really look forward to following that and touch in with you again once that framework is really up and running and gaining some traction. Catia and Durreen, I want to come to you now before we're almost out of time. But Catia, the Social Good Summit, obviously, we mentioned, began now over 10 years ago at the sidelines of the UN General Assembly in New York. The 75th UNGA is now underway with Climate Week, one of the few international climate summits taking place this year. So looking ahead for you as well in your initiative, Social Good Summit, what is that now doing to try to bring about, I guess, more climate action and climate finance? What will be the focus for you going forward?
Thanks, Thomas. Yes, so the Social Good Summit, the intent of the Social Good Summit is really inspire people to take action and educate. Surely, this conversation is quite telling that, the needle is changing in so many aspects. And I think that when the investors arm starts changing the agenda, everything kind of will fall. But the reality is that, climate action is all over us. We have the schools that are on the streets and they refuse to go to school. We have, organizations thinking about, making their net zero promises and governments doing their plans for 2050, which is quite interesting. The reality is that you are not going to solve this very, very complex that affects all of us if you don't have a large scale movement from civil society. So we can all go to streets and protest, but the reality is that we cannot wait for governments to take action, or even companies or hedge funds or the investment arm. Is actually a movement that globally we need need to collaborate and need to come together to actually truly make a difference. We need to change our habits. We need to understand what are the impacts in our lives, and individually, what can we do to the best of my full potential to actually solve this problem. The Social Good Summit is a drop in the ocean in the Australian civil society, but the whole idea is to actually incentivize people to really understand that the Sustainable Development Goals is not a thing that is discussed once a year in the United Nations, or is kind of treated as kind of a framework just for specific organizations. Is actually something that we all need to look at, has a collective plan to make the world a better place, where you and I and all of us, we make a contribution.
Thank you very much, Catia. I think that's all true, and I really look forward to following your work and see how we can support and be involved. Durreen, I'd like to finish on you, as we started with you as well. Looking ahead, and with the your very ambitious and incredible agenda and the work you do, what is, in your view, how can impact investors and impact investment make the greatest impact? What is your call to action, if I may?
Thanks, Thomas. And it was wonderful again to hear from all the panelists. I mean, really great points, and it was nice that we actually agreed on the whole inclusive side of finance. It was interesting. I actually spoke at the UN General Assembly yesterday, and you're absolutely right, Thomas. It was nice to see at least one gathering talking about climate, but more importantly, climate and the social side coming together. And I think that's something we cannot ignore anymore, which is climate action and women empowerment go hand in hand. So with that, I would say, looking forward, there are three things that we need to really be cognizant of. One is we actually need to really put our heads together and encourage and create innovative financial products for the market, where both the social and the environment side are given equal weight. And I think this is something that's imperative. And as the governments are coming more and more into the space as well, they need to use their public sector funding to make sure these type of innovative structures are being created. I mean, as we're proving with the Women's Livelihood Bond. The second, I would say, is transparency. And again, a lot of the panelists brought this up. And this is a very important one. We have now billion-dollar funds popping up every day with rock stars and everyone saying they're doing good. But the reality is there is a lot of repackaging that's happening. Now, any sort of investment in emerging markets are being called impact investing. That cannot be. So we really need to be using measurements and impact assessments, which we again do at IIX very rigorously, to really say what is the impact that's been created in every stakeholder in the last mile. I think we need to move away from saying just because you have a woman in the board, you meet the ESG criteria, which again is happening. And the last thing I would say is we need to move away from myopic way of thinking, which we all learned in the financial institution we worked in, or when we went to business school, or really thinking of just risk and return. It's not risk and return anymore. It's risk, return, and impact. And we need to really think of in terms of risk mitigation that happens if you're actually creating true impact. And again, it's very interesting. I think proof is in the pudding. While the markets are crashing, except for the tech stock, and we know there's a whole implication of that, let's not even go there. So I think as the market are crashing, it's interesting with the $200 million plus that we have unlocked from IIX and the investing that we're doing, we actually have not seen even a blip. And the reason is because we are working with the people, with the stakeholders in the last mile. And guess what? Life goes on, and they are actually finding ways to really work the economy, even in this COVID situation. So I do think that we need to think about finance as risk, return, and impact, and really be thinking of it in a way that mitigates the risk and makes finance stronger and makes it work for everyone, being inclusive. So thank you again, Thomas, for giving us all the opportunity to speak today.
Well, thank you very much for your insights, and I think that's a perfect place to end today's conversation. We are very much inspired by all your work, the four of you, and we've been very grateful to have you all with us today to share your insights and discuss on some really important topics, and we look forward to following the work you do. I also like to thank all our viewers and listeners for joining us today, and for all your questions. We weren't able to get to some of them. We tried to integrate them into the discussion as it unfolds. If you want to go deeper on some of these topics that we discussed today and others, please head to our website, where you can find all the essays in the Sustainability Special Edition of Disruptive Asia, including a great piece by Durreen. I encourage you to all read it, and also a forthcoming paper from Emily that we look forward to sharing with everyone shortly. Our next Disruptive Asia panel discussion is on the 27th of October, when we'll be discussing the geopolitics and governance of sustainability. We will have another great panel, including Dr. Meriden Varel from KPMG and the Lowy Institute, and Arjuna Dibley from Stanford University. Until then, stay well and keep safe, and bye for now.